Hello, welcome to this virtual portfolio institutional roundtable discussion. On the agenda today is emerging market debt. I'm Mark Dunn, the editor of Portfolio Institutional, and I will be your host for this discussion in what has been an interesting time for the asset class in the past year. Emerging markets were projected to drive more than half the world's economic growth, but then COVID took hold. Things changed. Investors dumped the debts, but they soon came back. So it'll be interesting to see exactly how the land lies with this asset class. And to find out, so we have assembled a focused panel of asset owners, an asset manager and a consultant. So let's find out who they are. Anders, if we could start with you.
Yeah, sure. So I'm Anders Lundgren. I work for Nest, auto-enrollment scheme of the UK. We're actually just approaching 10 million members now, which is about a third of the UK workforce. It began in 2012. Anyways, I'm head of public markets and real estate at Nest.
That's good. Thank you very much. Jean?
Hi, morning everyone. I'm a manager research specialist at Mercer, focusing on fixed income. So we meet with asset managers and have essentially a buy list of top-rated institutional managers in a variety of different categories. I'm based in Singapore. Focus is predominantly on Asian fixed income and broader emerging market debt strategies.
That's good, yeah. Thank you, Jean. Thank you. And Matt?
I'm Matt Murphy with Eaton Vance. I'm a member of the investment team managing our emerging market debt strategies, talking to you today from Boston.
Goodness. Thank you, Matt. Just let you know, I think your camera is just positioned just below your mouth. Are you going to move it down slightly so you can see the, yeah.
That's not what I see. Okay.
There you go. That's perfect. That's better. That's better. Good job. Great news. And last but not least, because you're dialing in and we can't see it at the moment, Andreas.
Yes, hello. My name is Andreas Antis. I've been working for PPF for the past 10 years. I'm a portfolio manager looking after the liquid assets, which includes emerging market debt, global equities, IG credit, and absolute return strategies.
Good. Okay, thank you guys. Thank you very much. Actually, Andreas, if we could stick with you, maybe you could tell us a little bit about the interest that the PPF has with this asset class.
Yes, definitely. We have been investing into emerging market debt since 2010. Admittedly, we have changed the style of investment since then. We started off with a benchmark related strategy and an allocation of about 30%. In 2015, we decided to take a slightly different approach. The allocation increased and we switched into more an absolute return approach. Given the fact that emerging markets, especially on the local side, could be a little bit volatile and capital preservation was of main interest. Since 2015, we have been quite active in emerging markets. We have been investing through external strategies as well as trading internally overlays across all the segments of the asset class, which includes, I would say, local currency, MFX, hard currency, high yield, IG, and corporates, which specifically is also some of the high convicted trades that we would do tactically every now and then in the portfolio.
Thank you very much for that. And Anders, what about you guys at Nest? What's your strategy in this particular asset class?
So we've been invested in a pooled fund with Amundi since March 2016. So it's a blended strategy. So it has sovereign corporates and local currency bonds. I mean, it's mainly sovereigns, but now corporate is 15% and local currency is 20%. But that has varied depending on their views. And right now we're thinking of adding a corporate hard currency fund as a building block. So yeah, we see some opportunities there.
Okay, and what are you thinking about a hard currency element there?
Well, it's a shorter duration, about half the duration than the sovereigns. It's now very big. It's bigger than the sovereign market. It's a bit bigger than the US high yield market. It's about 2 trillion. And we mainly invest for diversification reasons. And but you have a bit of a spread pickup, and most pension schemes don't do it as a separate building block, but we think it has some interesting qualities to add, and they're getting a bit more transparent on ESG as well. If you then they get better funding, but we can talk about that later.
Yes, we'll get to the point about ESG later, I'm sure.
Yeah.
Matt, what's exciting you about emerging market debt at the moment?
Yeah, well, it's always an exciting time in the emerging markets, right? There's always a good story and a disaster that happens every year. You know, today on the things that we're concerned about, COVID is still working its way through the emerging markets. We saw a lot of countries issue substantial amount of debt to give themselves a bridge to recovery, and we've seen inflation pick up. Beyond that, though, I would say asset prices reflect that and reflect worse. We do expect emerging market countries to sort of get back on their growth trajectory, maybe take the baton away from the US and the UK as they emerge here. And then this overall macro environment, going forward with the Fed sitting on its hands and the US stimulating, we expect that to wipe up on the shores of EM here pretty soon. So I generally say that we are in a recovery period right now. It always comes down to the individual countries. There's certainly some countries out there doing the right things. Ukraine and Serbia come to mind. And then there's countries out there that are doing the wrong things. Brazil and see who else can I pick on? It's called India as well today.
Okay, of course. And of course, as I mentioned in the introduction, I mean, you mentioned COVID there. There was a sell-off last March, but investors soon come back. So was that an ideal time for you guys to pick up some bargains? Do you want to take advantage of that?
It was the buying opportunity of a decade. The last time we had seen prices like that was back in the financial crisis of 2008 and 2009. We were fortunate as a team. Our colleagues in Singapore were the first to really let us fully understand the threat that COVID offered. And so we started to cut risk in February on the margin, and that gave us cash that we were able to put to work to buy some really attractive paper at very distressed prices through the back end of March and early April as well.
Okay. Anders, I've just heard there it was a buying opportunity of the decade. So how's COVID affect how you managed your emerging market assets?
Well, I mean, well, from a Nest perspective, we have manager meetings, and it's all been working very well with Zoom and Teams and so forth. When it comes to the manager, obviously, it's hard to get the same feel when you can't go and visit the countries, if it's all Zoom calls. And so certainly, but apparently that has been working quite well. And you could see that JP Morgan and Bank of America, Merrill Lynch, still went ahead with their EM conferences. And for the companies themselves, it can be quite convenient for them not to have to travel and just do Zoom calls. So it has been working surprisingly well, I think. And I think everybody would agree how well it has been working. If you wouldn't have imagined that before this happened, I guess. I was just going to add the reason about the corporates is also we're quite constructive on Asia, and corporates has a very high exposure to Asia. It's like 40-50% on the SEMB, if you use the SEMB broad or diversified. But so if you're constructive on Asia, that's certainly one reason to do that. So.
Gotcha. Fine. And Andreas, same question to you, really. I mean, how did you take advantage of the sell-off in March last year?
Yeah, sure. I mean, for us, we couldn't get our hands faster than we did once those opportunities were surfaced, to be honest. The huge dislocation, especially on credit, on the hard currency side of things, it was particularly attractive to ignore. So one of the things that we try to do is to load up exposure on the hard currency side of things. We've done that by buying into, short duration hard currency strategy where, the pull to par was also quite strong. And on the local currency, we did overweight slightly, but to be honest, that space wasn't particularly crowded at the time, so the dislocation wasn't as great relative to the hard currency side. So we instantly overweighted hard currency, and then we start picking up some names that they were trading in levels where they wouldn't make any sense to us. Obviously, one of the things that we need to take into consideration is the double whammy with oil as well. Obviously, the wars between the OPEC plus and the shale has caused oil to be trading almost to negative territory on the WTI side, with Brent at $10. And a lot of oil exporters' names were basically took a double hit. One from the pandemic and another one from the oil levels. And we tried to identify which names were actually massively dislocated. The obvious name that comes now into mind, I remember playing, was Angola, that it was trading 10 points below the default value. So one of the things that we've done is to identify those idiosyncratic names and start buying as much as we could in the back of that, because for us it was free money once normalization gets restored. And we have been quite active since then, try to take advantage of all the dislocations that they were offered to us since March 2020.
Okay. Thank you, Andres. Jean, can I talk to you about China? It's the world's second largest economy, although by the way it's growing by the end of this conversation, it might have overtaken and become the world's top economy. Big growth, but there are problems. There are questions over its human rights, questions over transparency. I mean, what are your views on the Chinese bond market?
That's a big question, Mark. I guess there's lots of different parts of the China bond opportunity set.
Yeah.
So we'd have to look at those in a little bit of isolation. But broadly looking at the onshore market and how that's opened up, hugely in the last 2 years in particular, with Bond Connect coming in, or 3 years since 2017. That's a very new phenomenon, new asset class for foreign investors. Before they were only limited to the dim sum market, the CNH bonds, and then to the US dollar bonds that were the offshore market together. I guess the view, you'd have to tackle it from a number of different aspects. The technicals are clearly very strong. Most of that is about index inclusion, so onshore rates bonds, that's government bonds, the sovereigns, and the quasi-sovereigns, the policy banks, the 3 policy bank issuers, being included in benchmarks that's now across all the major benchmark providers. JP Morgan, FTSE was the last one to join. That starts in October this year, and Barclays was the head of the rest of the pack. That creates a very strong technical for the rates bonds. The issue then you have to come to is what role that would play in portfolios.
Yeah.
If you're looking at China rates on a versus other sovereigns, if you're just looking for carry, you get a decent pickup, but a lot of that gets explained away by credit risk and the FX risk. So if you're doing it on a hedge base, it becomes less attractive. So you're having to take a view on the currency, and we can talk more broadly about other local currency views, but I guess it's a very big question. We can take that in a number of ways. To answer the question just broadly about China versus other EM, there can be a case made that it's still underrepresented in some of those indices.
Right.
Some asset managers may be allocating to China bonds ahead of index inclusion, or may already have had a weight prior to those being included in the benchmark, so as an off-benchmark allocation. And the other aspect is, if you are looking at beyond the rates opportunity set into private-owned entities or state-owned entities or LGFVs, down into the local government financing vehicles, there may be opportunities. It's largely an inefficient market, but from a spread perspective, you're probably not getting paid enough as an international investor to take that spread risk. And we've seen a big shift since last year in defaults, and the state allowing those state-owned entities to default, and that's seen a big repricing, which is probably positive for that onshore market. And I think we'll see increased interest from foreign investors. I'm interested to hear Matt's view in particular on that front.
Gotcha. And okay, Matt, he stepped you up there. So, any view on
Teed
that?
up.
Sorry, what'd you say, Mark?
Any view there on the China question in terms of your views on the China bond market?
Yeah, so on China's market, I would say take a step back. While China is an extremely important emerging market, it is just one country out there that you can invest in. The investment characteristics are certainly attractive, right? Particularly in the local market. You have a currency that tends to march to its own drum, so it can be a diversifier. You get attractive nominal rates. But to the point about it being, and they also get a fairly deep market, so big institutional investors can move a decent amount of capital there. The concern would be, and John mentioned it, Bond Connect delivers everyone's bonds into a single omnibus account that could easily, it's a tail risk, but it could easily just be wiped out and you lose your bonds. So we trade China by trading within the interdealer market onshore. That way we get to face Chinese counterparties. And I do think that this will continue to grow. I think China will continue to grow as an allocation. It might become a standalone allocation. But at the end of the day, that's just one country out of 110 countries we can choose to invest in. Okay. We had been long rates. We had been long currency. We took that positioning off to start this year, which has been appropriate.
Gotcha. Okay, guys, China's so big. Do you think it should be considered part of the emerging markets or maybe standalone within the emerging markets? What are your views on that? John, what are your views on that?
Yeah, as I said, there can be a case made for that being such a large part. I know it's one of just 110 countries, but it is significantly large, and depends how you look at the EMD opportunity set. If you're looking at it on a GDP basis or on a growth, share of global growth basis, China is an outlier versus a lot of other EM countries. It's alongside DM just on a size perspective. So if you look at it from that perspective, we've seen some clients interested in an EMD ex-China allocation and looking to access China through a standard allocation. That might be, then using onshore rates as a base and selectively adding some credit risk, both in the offshore US dollar market, hard currency market, as well as very selectively, and this is probably going to increase over time as we see that credit differentiation increase in the onshore market, adding CNY bonds, so in SOEs and corporates. Cases to be made, I guess the benefit of that, more flexible approach in a standard allocation, different alpha drivers. You'll still get the diversification that Matt spoke about. You're not necessarily taking a singular currency view. You can play CNY versus dollar as an additional lever. You can hedge that if you want, depending on your client's preferences. So you can take some of those levers as you pick and choose. And sometimes I think with China in particular, that will be directional. It's very policy-led in terms of what drives the bond markets there as well as the currency markets. So there may be some cases for that standard allocation. But in a broader emerging market or in a broader even global fixed income portfolio, of course, it does have diversification benefits. So it depends on how you want to look at it in your portfolio. To little consultants on, so I'm conscious of that.
Thank you, John. Changing the subject here a little bit, Matt, I know you talked about last year being a great opportunity, best opportunity for 10 years, but in normal times, how would you go about trying to find undiscovered value in the emerging market debt universe? What's your approach?
Well, the approach is to recognize that there's informational advantages that exist, but it's on a spectrum. So we are, one of 1,000 analysts covering China, if you will, right? So my opinion is one of many, and that's what makes a fairly efficient market. But the reason we use such a large universe is because maybe there's not as many people paying attention to Myanmar, as an example. So it's an example that's certainly been in the news lately. That was a country that we've been following for quite some time. Nothing available in the debt capital markets, probably won't be for a while, but that was something that was getting close. And so our job is to understand sort of what's happening at the individual country level across the world. What's happening is a function of policy and politics. And what we're really looking for is countries that sort of there's a misperception the market might have a stereotype associated with the country based on its past. We're doing our best to find sort of green shoots of improvement. And a lot of our approach is identifying these good reform stories that take time to unfold. If we're investing early enough, if we're investing before the rest of the marketplace, we tend to get a lot of benefit for our clients in doing so. And as that country's risk premium declines, that's generally what, quote unquote, makes it a little bit safer. And that tends to bring more capital to the country, further compressing spread, further pushing currency higher. So our job is essentially be there once the country begins to make that turn, not wait for the country to improve before we invest.
Gotcha. And another interesting point here, which actually raised by Anders, and you mentioned yourself, there's 110 countries you're watching. How can you know exactly what is going on in all these countries? How can you be on the ground? I mean, you're sitting there in Boston, so how do you know what's going on in Myanmar and all these other countries?
So the first step that we take is collecting that information, which can be quite time consuming. The way we beat back on the time consumption was it's about 8 years ago, we built a machine learning tool. So it goes out in the World Wide Web, scrapes the information that we're looking for on individual countries, drops that into our database, categorizes it based on topic, caches that so we can pull it up at any time. And now we're able to have the machine tell us, sort of our view on the biases in that source. The machine's now able to translate foreign language documents. So getting Russia's view, Ukraine's view, and the sort of the American or English view on what's happening in that country. And then every morning, our regional teams are essentially covering what happened in all those countries over the last 24 hours.
Okay.
So that gives us a very broad scope. And those discussions in the morning are to figure out where we should spend more time. And that, to your point, Mark, is where we end up getting on the ground, if you will.
Yeah.
So we're looking for those perception problems. We're looking for binary events, so a piece of legislation. And then occasionally we have times like we had in March of 2020 where you had very irrational pricing. So a very big canvas of the world, and we use technology to make sure we don't miss anything. There's no slippage. And then when it comes time to learn more, we go and we visit in country as much as we can.
Good, great. Thank you very much. Anders, actually, you did explain a little bit at the beginning about your approach. I assume you use external managers, specialist managers. Is that correct?
Yes, we tend in general to use one manager for each asset class for asset allocation reason. It makes it a bit purer. When it comes to EM, we actually have a blended approach, but it's mainly hard currency, the Amundi blended global emerging market fund, I should say. Okay, so if you have an active approach to this market, what would you look for in a manager? What would you want that manager to be able to do? Well, one thing is obviously the team, the knowledge, the experience, how long they work together is very important. But I think in terms of accessing information, which is extremely important in emerging markets, not as transparent in many countries like in Latin America, that region. So then relationships becomes very important. Like the team, how diversified is it in terms of languages? So in the Amundi case, they spoke 20 languages between themselves, and from Russia, Turkey, China, etc. So that would be something we certainly consider when we're picking the manager. Okay, maybe. And Andreas, what do you consider when picking a manager to tackle this asset class?
Yeah, I think it's really important to understand the strength of the team, as Anders pointed out, the experience that comes with it. Another interesting thing that we tend to look at is the investment process itself. We tend to look for what differentiates the managers relative to the rest. I mean, all the managers can look at fundamentals and other basic approaches in order to come up with an investment thesis. However, we do look what would be the niche of every manager, and we will take an active decision on the back of that. For example, we have identified strategies where they are more geopolitically driven, although they do pay attention to the technicals and the fundamentals of the countries and the regions and the actual names on the paper. Where the value comes from is identified any potential, IMF interventions, reforms coming in place, elections taking place. So those would be the primary catalysts in order to extract value from this from the space. So we tend to focus a lot on what kind of differentiation these strategies have relative to the peers before moving ahead.
Good. Well, thanks for that. One thing I've picked up from speaking to you guys is that information is difficult to get hold of. I mean, are there third-party companies that provide us data on emerging markets that you guys use, and how reliable is that information? Does anybody want to come in there?
I can. Please, Matt, you're the
Matt first, then Anders.
Yeah, we don't use a lot of third-party information.
Okay.
So, primarily because we don't trust it, right? I mean, in emerging markets, your base case should you don't trust anything. You should not trust anything you're given. You should work to verify it. So the thing about third-party, and if I can, I'll branch this into ESG here for a moment. We have a lot of entities out there now that are trying to provide their scores and their views on various corporates in various countries. And at the end of the day, there's nothing to determine whether or not that's material. All of those come with a lag in terms of the information is usually posted after the fact. And there's no skin in the game, right? There's no way that third-party information can be empirically shown to drive investment performance. So much of what happens in the emerging markets is recognizing where you have that advantage, so the informational advantage, and then bringing in multiple teammates. Maybe that's the difference for us, is bringing in multiple teammates to offer their perspectives and their views. And then we use the phrase on the team to try to identify the best truth, right? There's going to be things that are unknown. There's going to be a lot of unknowns. Try to identify those and then try to get a sense for what's accurate. So our view on third parties is that information typically is fairly stale and is not reflective, or it has no impact on the ultimate investment outcome.
Gotcha. Okay, thanks, Matt. And Anders, do you share Matt's view there on the third-party data available?
Yeah, I'm encouraged by that answer. I think certainly a lot of managers are very dependent on Sustainalytics and MECI data, but if you got that data today, you'd be lucky to get end of 2020. It's more likely you'll get end of 2019. So it's very, very out of date. So having, as we talked about, feet on the ground and getting access to the companies. Obviously, if the manager also has a strong equity team, they can work with them, and then you get more relevant data and more up-to-date data. So I think that's key when you're thinking about the manager, how they get access to that ESG data.
Yeah, if I can jump in there, I think, covering lots of global fixed income or more sort of developed market strategies versus EM, that's one clear trend that we see from a manager research perspective. In EM, everyone, as they may have tried a lot of external data providers in the past, maybe not quite as skeptical as Matt from the off, but they've all gone back to where you are now. A lot of them have tried them and decided that they need to do that legwork themselves. So, from an ESG perspective, inherently you're looking at governance for any issuer in an EMD context, whether it's corporate or sovereign. But looking at those environmental issues and those social issues increasingly, you can't trust what you're first told. You have to dig deeper into each of those, and you can't rely on external data providers to get that color. So, all the managers are having to do a lot more of that legwork themselves. Whereas in DM, I think it's more of a that there are data providers that get enough access and transparency that they can form a view, and there's more timeliness on that information being provided at the same time. So it's a definite divergence between EM and DM.
Okay.
If I may, I would say I agree with the guys. The one thing that we have experienced ourselves is the fact that when we try to gather data, especially in emerging markets, across economic data or macroeconomic data, what we have discovered is that the process data, where far from being accurate. And then we started looking into more raw data where actually there wasn't any particular way to access them in a free manner. So we had to spend as a house a lot of money into getting data through subscriptions through various providers, where eventually we had to reconcile between them and get them into a raw form. And in order to start actually making sense, we had to process them ourselves and bring them to the shape where they would start adding value. But relying on readily available data on emerging market debt, it was an issue for us, especially when it comes to more generic top-down data rather than data coming from every individual segment of the market.
Mm-hmm. Okay, this is quite a big issue, of course, and we can't have a conversation about anything in the investment markets at the moment without touching on ESG, and I think it's already been mentioned already by Andres. So, I mean, how applicable are ESG factors in emerging market debt investing? Gilles, do you want to kick us off with that one?
Sure. I mean, I think we talked a little bit about that in terms of the access to information piece, but it's definitely something that, as I said, in governance, it's been in EM for a long time to understand the structure, whether it's the sovereign or at the corporate level. That's been incredibly important. I think it's a big deal in EM, but it's also harder to do. The informational challenge we talked about. On the social side and the environment side, a lot of EM are playing catch up in terms of sources of energy, for example, where they are and what's deriving productivity in some markets. It's hard to change that at a flick of a switch. It's a multi-year project in some instances. The big increase that we've seen recently is engagement. So that's something that increasingly, I guess, EM markets are typically smaller. So asset managers that are engaging, even as a debt holder, are able to have some more impactful conversations even with sovereigns. You've seen examples of big investors getting involved in sovereign debt and trying to force the hand of some of the issuers. So that's a big trend over the last 2 years. I think that we've seen a big increase in. It's not good enough anymore for a bond manager to say, well, bond managers, we don't have a say. We're not equity investors. They now are expected to engage.
Can I ask you a question? Sorry, Mark. On that, do you think if they score well on the ESG, that they can get a lower cost of funding thanks to that?
Yeah, I think you see it. I mean, it depends. We could talk probably about green bonds. It's a big topical area in my neck of the woods out in Asia, with China issuing a lot of green bonds. But if you look through the use of proceeds and the kind of standards around some of those issues, you could argue whether or not they are truly green bonds. EU's done a lot more in terms of setting regulation frameworks around what constitutes a green bond or a social bond. But in Asia, we're still kind of catching up. And so, despite that, if it's labeled a green bond, we've seen some bonds pricing at a discount to their straight bond. So the cost of capital has been lowered. There's lots of evidence of that for some issuers.
If I can offer just one quick point on the ESG and EM portion. I mentioned before that a lot of what's been provided doesn't have any direct impact on the investment outcome. But there's good news in that there is something out there that does have a direct impact on the investment outcome. And that is changes in a country's level of economic freedom. So when you think about economic freedom, that's rule of law, that's soundness of money, responsible fiscal, responsible regulatory. When we engage with countries, we're showing countries that if you adopt these things that improve rule of law, improve monetary policy, et cetera, then your borrowing costs will decline. So all the empirical information basically proves that out. Right? Think about a country's risk premium as a function of the risk of investing there. If they adopt economic freedom and you feel a little more comfortable about investing, they get to borrow at lower rates. And the key is that economic freedom leads to the ESG outcomes we're all shooting for. right? So if you're looking at the SDGs, there's 17 of them, say about 14 of them relate to the outcomes we're looking for. So as a country improves its economic freedom, you get a reduction in poverty, increase in life expectancy, literacy rates increase, education rates increase, et cetera. So if you're actually looking to do good, invest in countries that are improving, and then we as a team engage with them to make sure that they can continue to improve. Maybe the key difference, though, is that we're not going to make headlines in doing that. Right? No policymaker is going to get up in front of his or her parliament and say, we're doing X because Eaton Vance told us to. Right? So we need to show up and engage where we are experts and where we have credibility. And typically it's on proving on the margin those things that relate to economic freedom, transparency being one of the more important ones today. So we had a sit down with the finance ministry of Benin, where we showed them what other sub-Saharan African countries are doing in regards to transparency and how they need to catch up. Essentially, if they do such things, you could reasonably expect borrowing costs to decline. And it happened exactly like that. So they improved their dissemination. They came to market earlier this year at much tighter spreads than they had seen before. And so there is a way to impact the asset prices, and there is a way to also impact sort of the positive outcomes we're all looking on the ESG front as well.
I think, can I just add on to that point? I think the other aspect of the high ESG scores or lower ESG scores is that there's studies done on correlation between those ESG scores and volatility of the bonds. And that's something that I think is a structural trend, and some of that's just down to the investor base that's investing in them. Those investors are in for a longer time period. They're all sticky money, and so they're holding on to those bonds through thick and thin if they believe in the fundamentals, and those are complemented by having sound or lower ESG risks. So there's a tie-in inherently to sounder fundamentals and lower ESG risks. And that's another attractive nature of having a higher ESG score. How you come to that score, you can come back to that versus external versus your internal or proprietary views.
Interesting what you were saying there, Matt. I mean, obviously, when you're looking at a bond, one of the big things you're looking at, can the person issuing it, can it afford to pay the coupon? Will it afford to pay the coupon? Will it return the principal? But on the ESG side of things, have you ever decided against investing in a particular bond because of the ESG profile, because you don't think that the issuer is going to be too cooperative in an engagement?
All of our ESG assessments are part of the mosaic. So, I don't want to overstretch here and say that everything we do is a function of ESG, but we do think that governance, to Jean's point, is the most important thing in emerging markets. And so if we're seeing a deterioration in governance, and that can be the way a country is thinking about its fiscal policy, the way a country is thinking about its trade policy, the way a country is treating its people, essentially. And that will give us pause to essentially recognize that what we're getting paid, essentially is the potential return going to compensate us for those risks. And so there's plenty of countries out there that we have not owned in the past. So we didn't own Argentina when it defaulted, didn't own Ecuador when it defaulted. A lot of that was a function of what we saw was the deterioration in governance. We are sort of known for being chronic bears in South Africa. If we don't have to own it, we won't, because there's been a continued deterioration in the rule of law there, continuing deterioration in property right, and further threats. And so that's what we're focusing on is if economic freedom is improving, the country risk premium goes down, you're going to get paid back on those bonds, and you might get some price appreciation as well if the country premium declines. We're going to be hard pressed to invest in a country where that premium is increasing, because you need to get much more compensation for that risk, particularly if the trend is not your friend.
Gotcha. Okay, thanks for that, Matt. Andres, bringing you now. When it comes to ESG, what are the big issues for the PPF?
Yeah, obviously we have been quite active on ESG. Admittedly, it's one of the dominant things over the past couple of years, where as a fund we try to be quite ESG aware and impactful as possible across all the asset classes. Particularly for emerging market debt has been, fairly challenging. I would say because of the nature of the asset class itself. trying to assign credible scores to this asset class can be quite a challenge given the quality of the data coming out of it. Also, quite aggressive changes in the regimes can cause volatility to the ESG scores as well. So we try to take a little bit of more practical approach where we are trying to use the UN sanction list as a number one filter, and then trying to enforce the strategies to be PRI signatories to an extent. Then looking into the individual countries and regions, obviously we have inclusion lists in place, but it hasn't been as straightforward as with developed markets. And for example, South Africa, if you take the biggest corporate names there is one of them is Eskom, right? And it's a utility name, which if you think about the environmental impact that it has, I mean, that thing is a disaster. However, the region overall, in a kind of the country overall, it should be a good place for potential investment. So that would be one of the things. Another thing we try to do ESG related. It was to provide liquidity to distressed countries in order to help them economically and financially, usually through investing into high yield and frontier markets. Obviously, those countries are fairly in distress, but we tend to work in line with the IMF and provide capital or access to capital for those countries. So in essence, we kind of trying to help these countries, distressed countries, to overcome their financial difficulties by collaborating with and providing liquidity in collaboration with IMF in doing so.
Gotcha. Thanks for that, Andreas. Moving from ESG now, because time is getting on. I've been reading that the emerging markets are entering a new commodity super cycle. If that's true, because I mean, how's that affecting your strategies or how you're seeing emerging market debts? Would anyone like to kick us off on that one, if it's having an impact at all?
So for our approach on the commodities, you said you've been reading there's a new super cycle.
Yeah.
Sure. Sure. I guess there is. Because the bigger thing for us is that, commodities is certainly a risk, and it certainly has an impact on a country's ability to pay. Think of Angola, which has already been mentioned. But the fact is that we're not commodity managers, and we don't have a view on those. We think those are fairly efficient and difficult markets to call. So we're going to think about higher energy prices. If those sustain, what's that going to do for our countries that are importers? And then if that sustains, what's it going to do for the countries that are exporters? Because usually when oil prices are high, you start to get fiscal slippage, right? Most countries think things are going to be good forever. And so what we try to do is actually at the individual security level, if we are given that flexibility by clients, we'll look to hedge some of the ability to pay risk. Okay. So back in 2011 and 2012, we owned Venezuela dollar debt. Okay. We had out of the money put option on Brent on the other side of that. And then 2014, those bond prices got cut in half, but that option certainly kicked in for us. So the key there is that it's a risk inherent in the security we don't have a view on. And if we have permission to do so, we'll try to take that risk out. And then at the overall portfolio level, we'll stress test to see how our portfolio moves with changes in energy and commodities versus the benchmark to make sure we're not taking any unintended bets, if you will. So I'm happy to say that maybe the super cycle's here, maybe it's not. At the end of the day, it's too hard for us to call. So we're going to think about the impacts at the country level and then broader at the portfolio level to make sure we're not making a bet on commodities one direction or the other.
Okay. Manders, is this something you're discussing with your manager, working to the strategy?
Yeah, so they and we actually mentioned, or actually Matt mentioned Ecuador a moment ago. They've gone through debt restructuring, and Zambia is going through it. So they're quite positive on those bonds from those countries. And in general, the portfolio is skewed to commodity exporting countries right now, because our manager believes there is, there is a commodity expansion, and yeah, separately we have a commodity fund, so we invest in the commodities through that.
Gotcha. Great. Okay. Jean, developed markets have used a lot of helicopter money to sort of the problems that the pandemic has brought to their economies. I mean, what do emerging market economies have in their toolkit to use here to try and start some of these problems?
Yeah, interesting question. I think we mentioned Ecuador and the IMF presence there. Some external factors, may be important in that consideration, but it comes back to a point Matt made earlier about how much debt individual countries can take on. They don't have as much in their toolkit. They can't take on as much debt as developed markets. The UK having 120% of debt to GDP is not seen as a problem, whereas if South Africa has 80% debt to GDP, it does at the moment. That's a big issue, and some of that's about the perceived credit risk. Some of that's about liquidity. So they don't have anywhere near as much. Those that are willing to take some austerity measures and work with the IMF may have significant access to some of those facilities. Ecuador is a great example. Following the election 2 weeks ago, the new regime in there, they've committed essentially to those austerity measures. They're going to get access to probably I think it's $1 billion. Matt probably knows, in special drawing rights from IMF. So that's significant help for them in terms of that fiscal stimulus. But only some of that can come from external. A lot of it's down to the growth story and stimulating growth from internal. I can come back to China and talk about what they have. Again, a bit of a standout from other EM. But they have huge reserves in their armory, which is a bit different to most of EM in terms of how they can control that. And they've pivoted hugely in their latest 5-year plan to relying on consumption and driving that GDP growth through the domestic economy rather than relying as much as they have on exports. And you might see some version of that for other EM countries. That can rely more on their internal consumption to drive GDP growth.
Okay. Does anybody believe that rising interest rates could lead to another taper tantrum regime in the emerging markets that we saw a few years back, or is that not going to happen this time?
Not going to happen this time.
Why?
There's just it's a different world. So the taper tantrum, May 25th, 2013, day that'll live in infamy for all emerging market debt managers. That came at a time where EM had been on a pretty sustained bull rally since the depths of 2009. So you had a 3-year rally that had pulled a lot of capital into the emerging markets. And the key was that the Fed tightened, right? So the Fed said that they were going to reduce purchases. On the margin, that's a tightening of monetary policy. That was a shock. And all that capital that had run into EM then came running back out. Today, people are concerned about rising rates, but it's not because the Fed's going to tighten anytime soon. Current accounts, meaning sort of what the countries have in terms of external vulnerabilities, are a lot less concerning than they were in 2013. And you didn't have 3 to 4 years worth of massive capital inflows all head out. A lot of the capital that flew out of EM in March of 2020 equaled the same sum that came out in the taper tantrum. So we've already had the taper tantrum. It was March of 2020. The capital is just slowly starting to come back into EM now. So I think any discussions of taper tantrum 2.0 just completely miss where we are in this environment compared to 2013.
Does everyone agree with Matt, or does anybody have anything else to add to that?
I would just add that obviously the dollar, the strength of the dollar is very important. I mean, I would say our dollar conviction is low. There's opposing forces with stimulus leading to excess dollar supply and a weaker dollar, and then a stronger dollar due to people buying, U.S. assets. But which of those two forces will win is the question. I would say.
First quarter,
but it does affect the EM, of course.
Yeah. First quarter, the dollar won. We'll see. Yeah, to your point, we'll see what happens over the next, call it 12, 18 months here.
Yeah.
Okay. Time is catching us up a little bit. We're almost in our discussion period. There's one final question I think I'd like us all to answer. I'd just like a little bit of an outlook of what you guys think is going to happen in the emerging market in the next 12 months. So Matt, could we start with you? Could you tell us what you're expecting to happen in the next 12 months?
Sure. So next 12 months, I expect asset prices to continue to sort of grind higher here. The reason being is that the economic recovery is on its way. So it's coming in fits and starts, but over the next 12 months, I'd expect sort of the baton to be handed from what has been exceptional U.S. growth to the rest of the world. So think about the stimulus sort of washing up on the shores. And then from a macro perspective, I expect continued negative real rates in the developed world. That's going to lead to a search for yield. That's usually good for EM. And as was mentioned, I will stick my neck out there and say I do think dollar is going to be weaker here in 12 months, primarily a function of monetary policies I described, but also big widening of the trade deficit, big widening of the fiscal deficit usually has an impact on the US dollar after about a year or two lag. And so I expect that to give EM another tailwind here. So in an absolute sense, emerging markets are cheap relative to their history. And then in a relative sense, they're extremely cheap relative to more traditional credit, such as high yield or investment grade corporate today. So that's going to attract buyers. And that's why I come back to the point that I think EM is just going to grind higher here over the next 12 months.
Okay. Andreas, what are you expecting to see in the next 12 months?
Yeah, I would say I'm in the same camp. We were expecting to see positive, on an absolute basis, positive returns coming out of the major markets. I guess the question is what is going to drive them within the major markets, whether it's going to be, local currency or hard currency. Overall, we think if we look at the current position, for example, the foreign flows, etc., they do indicate that local currency is expected to deliver positive returns in the next 12 months. If we look at the real yields as well, so inflation consensus expected to come down, that will push real yields higher. This is again strong indication for positive local currency returns. We are estimating roughly close to 6%, I would say, in the back of that for the local currency. We do see a bit of a lag effect on the high yielders relative to where the IG is trading as well. And so we are anticipating that the frontiers and the high yielders are also going to perform well on a relative basis. And we are expecting, I would say, fairly muted to slight positive returns on the hard currency. And the only reason for that is that although the flows are in favor and they have been muted relative to the local currency since the beginning of the year, the spreads have been, relative to history, have been quite tight. I would say, but still, that doesn't necessarily imply negative returns. On EMFX, I mean, if you look at it on a real effective exchange rate basis, on a real basis, inflation adjusted, it has come back a lot since March 2020. However, it's still cheap. But again, this is a function of how the dollar is gonna perform. Admittedly, on the short term, as in the next 2 to 3 months, we are expecting the dollar to appreciate. Hence, we are not currently overweighting EMFX. However, again, in the longer term, we are expecting EMFX, given where it's currently trading, to appreciate a bit further, given the valuations have been so cheap.
Gotcha. Okay. So thank you very much, Andreas. Jean, what is your research pointing to that might happen in the next 12 months?
Yeah, a lot of the sort of I would very much agree with what Matt and Andreas have said so far from a macro perspective. I mean, of course, the big difference is in EM, there's going to be a lot of idiosyncrasy about individual countries and issuers. So there's huge divergence in vaccine rollout, and as a result, growth recovery stories in various EM countries. There's going to be, there's always an election calendar. There always are going to be some surprises within EM. But broadly, yeah, we have a more favorable view on local currency at the moment. Again, agree with a lot of the points that Andreas made. Nothing really new to add there. And broadly, EM across the board, though, both in hard currency corporates and in local currency, we expect to see positive returns over the next 12 months with that slight favorability towards local currency. I guess from an implementation perspective, we look for a more flexible approach, especially on the local currency side. Some of that is particularly important at the moment because of the divergence you see in the recovery from pandemic and back to growth.
Okay, thank you, Jean. And Anders, the final point of the discussion goes to you. What are you expecting to see in the next 12 months?
Well, we think there's little room for spread tightening. I mean, obviously it depends on the market, but in general, but you still get a very good carry, so we expect positive returns. We think the fundamental outlook is good. We talked a bit about inflation, but inflation also means that commodity prices go up and the companies are increasing prices, and there's just a positive environment for global risk assets. So we're definitely positive.
Okay, thank you, Anders. Unless anybody has a final point they want to raise on emerging market debts, I would like to thank you all for your time. It's been an interesting discussion because a very big investment universe, of course, and I'm pretty sure we'll be revisiting this probably this year, maybe even next year, who knows. As I say, thank you all for your time. I'd especially like to thank our sponsor, Eaton Vance, for making this happen, and I look forward to catching up again soon. Thank you, guys.
Thanks, everyone.
Thanks for your time.
Thank you, everybody.
Goodbye.